Hey everyone, welcome back to the Capital Mindset Show. Today we're going to be doing another subscriber request, and this was voted on by the Discord community, so you can actually have your voice heard down in the Discord community below in the comment section. It is free to join, so you do have to go through the filtration process because we don't want to allow any bots in there, but if you guys want to join, it's down below in the description. Otherwise, here we go onto the video. We are going to be reviewing two people's portfolio of different sizes. One person's portfolio is, one of the large hedge funds, and the other one is a larger creator here on YouTube and uses eToro in order to actually run people's money, so to speak. It's a different system. It's a copy system, but we'll get to that person. So we're going to also go over some of their positions in detail. The hedge fund we're not really going to be going over because it's too many positions, but we'll have some commentary here and there. So this is either part one or part two, depending on which one you are viewing right now. But we're going to begin, of course, with Bridgewater Associates, and that goes with Ray Dalio. Ray Dalio is the hedge fund manager there. They are more like a mutual fund than a hedge fund, really, in reality. And we'll go over exactly what are their holdings, specifically their allocation strategy. And I'll share that with you guys here because it's really important that we get an idea of this. If you actually take a look, there's a large exposure to bonds to the tune of 55%, and that already kind of gives you the idea of, they have a lot of exposure to inflation risk, okay? Because we have 15% in interim bonds, 40% in long-term bonds, and the inflation risk actually is longer or greater felt in the long-term bonds. But they have some inflation or traditional inflation hedges in commodities and gold, which makes up about 15% of their portfolio, and stocks making up about another 30%. We're going to look at this person's overall portfolio, but just to give an idea, the concept of assets under management is very important to understand the motivations behind this investor. So something to speak about. Assets under management is the primary goal of a firm like this, and Ray Dalio is a very good salesman. The sales pitch of this portfolio is it will do well in all conditions. So in all conditions, it should do very well, or not very well, but well. It may not outperform certain indices in certain given time periods, but that's the sales pitch. The sales pitch is stability. Wealthy individuals might actually go for something like this, maybe, or maybe not so much wealthy, but in aggregation, a decent amount of people would go for something like this. And there you go, you get your AUM up and you get your fees up. So going over to some of their stock holdings, we're going to first go over the ones that they're removing from the portfolio. And we can see there's the emerging markets index removed about 55%, Walmart, iShares, core emerging markets. So a lot of emerging markets, China ETF. I believe there's also a large cap China ETF, which I'll actually showcase why that's interesting. But yeah, you can see where the person's or this individual's kind of removing it. You see the SPY. If we actually organize this according to size of the portfolio, we can see that SPY is actually the largest holding, followed by Procter & Gamble. Procter & Gamble is actually an increased this more recently. PepsiCo, Johnson & Johnson. So these are kind of inflationary resistant or traditional inflationary resistant positions. Very interesting to see that. McDonald's increased. Walmart was down about 43% in terms of allocation. Very interesting there. Taking a look at the increase, though, we have Pinduoduo, JD.com, Beijing, Baba, Baidu, a lot of Chinese stocks, even though this person has been removing a decent amount of ETFs regarding Chinese stocks. So very interesting. This tells me this person is making a more concentrated bet. At least they're putting more capital to work in those positions. Note the size of the positions, by the way. So the size is very important because they are adding a lot, but the size is very small. So those increases look very large. The one that is decently sized increase was Johnson & Johnson, because you see it's 3.8% of the portfolio, or sorry, 3.08, and it increased by around 12% or 12.5%. Kimberly-Clark, smaller amount. Starbucks, actually a smaller amount there. Starbucks was an interesting ad that they added, and it says apparently the price was around $113, and today it's sitting at much lower price. So with that being said, kind of my preliminary thoughts, very quick discussion about it, really, because there's not much else to say. I'm not going to be going over every single stock. It's too much. We're not going to do a 3-hour-long video. For the most part, I'm somewhat perplexed as to why this fund has so much ETFs. So basically, I'm basically getting a lot of random diversification in terms of weighting, and I don't really. I'm kind of telling the theme of it, but I also can't. There seems to be a decent amount towards hedging against inflation and a decent amount hedging towards deflation. So I can see why it's all weather, because you're basically inflation and deflation simultaneously. I prefer not to concern myself with that, but I understand that Bridgewater Associates is marketing itself towards a particular audience that has a particular set of goals, and that's all well and good if people want to. You know, no one's gonna force anyone to do it. They are deciding to invest with Bridgewater Associates. It'd be interesting to see how they perform over long periods of time. My hunch is that they're not going to perform very well because they're not going to be allocated to the proper assets at any given point in time. They're just going to be spread out everywhere. And my other concern, well, not my concern actually, my commentary or my sub-commentary to that statement is simply that that's fine. That's not who they're really going after. They're not going after the people who want to outperform all the time. They're not doing a ARK invest marketing strategy. They're just, you know, trying to say, okay, we're going to be stable. We're going to provide a sense of stability, and we're going to grow over time in this way. So that's the case there. All right. So on to part 2 of this video. So go check out part 2, and we're going to be talking about Robert Reynolds.